Hello, my name is Kamal and I'm an option trader. I'm sure you've probably been hearing a lot about options recently. You've probably seen some posts on Facebook of people talking about it, all this return, 100%, 200% return on the investment, 1,000% return on the investment, even sometimes even 6,000 to 10,000% return from option trading. And you wonder exactly how are people trading those options? How are they making so much money? Can I do it as well? Is it complicated to know? Is it complicated to learn? Absolutely not. It really is very easy. It's just very simple. You just have to be very careful what you're doing, which is why I decided to make this video. Typically, when I started myself, of course, I was watching a bunch of videos on YouTube trying to understand this whole thing. A lot of videos that I've seen out there, they're more technical, so you really have to be focused. But if you don't really want to look at all the technical aspect of it, there's a very simple way to actually understand option trading, which is what we're going to do and cover here today. This whole thing will not last no more than an hour, so stick with me, and I'm sure by the end of this video, you will love it. Let's get started here. To see my screen on your end. Move this down. It's right here on the side. So sort of have an agenda of things that I'd like to cover today. So we're going to slowly go over that agenda, and so it's gonna move in this to the right place, so we can focus on what we need to focus on here today. And you can come right here, right on the bottom, so you're not distracted. Okay, so if you're looking on just on my screen here, just gonna get to guide you here what will be happening. Okay, so this is good. So on the left side, this is essentially a list of things I'm going to cover. On the middle, this is going to be a board where I will be writing, and right here on the right side, this will be, of course, my phone screen where I have currently the Robinhood app. So this is mostly going to focus on how to trade options with Robinhood, and of course, you could trade the same way with other, whether you use TD Ameritrade, or you use Thinkorswim, or use Webull and E-Trade, etc. So what are options? So essentially, an option is essentially just a financial contract. So between a buyer and a seller. So as a buyer, oops, we don't want that to happen. So as a buyer, so you essentially want to purchase, you're essentially making an agreement to purchase a contract from a seller. So both the seller and the buyer come to the table and they decide on a price. So, but this agreement is not something you will purchase right away. So the underlying asset, whatever you are going to purchase, you're not actually purchasing right here, right now. You're essentially making the agreement to purchase the underlying asset, whether it's a house, a car, or a stock. You're making the agreement to purchase it in the future. It could be 1 week, 1 month, 1 year, 2 years, etc., but sometime in the future. So both of you, the seller and the buyer, will have a contract which both were agreed on, and you as a buyer, you're essentially purchasing that agreement from the seller, but it essentially will give you right to actually follow through the agreement, but not the obligation, because you are the one, you are essentially paying premium so that you can have the right to have that kind of agreement with the option seller. So the option seller on the other end does not have the right, but the obligation to actually sell you the underlying asset if you decided that you wanted to buy at some point in the future whenever you're ready. Okay, so to put this in the most easiest way here, so we have let's start running this down. So we have buyer A, and you have seller B. And this is a contract between both of you. You come down to the seller, you're essentially paying a debit, which can also be considered a premium, to the seller, so that you can purchase the contract from that particular seller. So the seller will receive that premium. Once the seller receives the premium, he's essentially holding on to your money. So what will happen then? So right here, as a buyer, the contract that you're purchasing for an underlying asset, let's say it's for example, let's say it's for Uber. So right now I can see on my screen here that Uber right now is $33.15. So Uber is 33. So with this seller, I'm telling the seller that sometime in the future that I will be purchasing the share of Uber for $33. And right here, I'm going to put an expiration, let's say July 31st. So sometime in the future, on July 31st, I'm paying a premium to the seller to say, hey, and sometime on until July 31st, I want to be able to buy a share of this Uber from you for the price of $33. So as a buyer, what am I hoping for? So as a buyer, what I'm hoping for is that at some point in the future, before July 31st, Uber start to trade somewhere maybe around $40. Okay? So I'm hoping that Uber start to trading maybe $40 or even more so that I can come and exercise my options. If I need to, I don't have to exercise the option, but if I decide to exercise the option, so what will happen is I will go back to the seller B and say, hey, seller, remember we have an agreement that you will sell me the share of Uber for $33, okay? Currently, Uber is trading for $40, right? So instead of me buying Uber for $40, I will then buy it for $33 from this seller who sold me that contract. And then I can go into the open market and I can sell it for $40 here. And from that point, I will now have a profit. So if I purchase one share, then I will have a profit of $7. Okay? So, but obviously, $7 is the current profit. But you also have to remember that when you purchase the contract, you spend some money when you paid a debit when you for this contract. So let's say you pay a debit of $2 for the debit for you to have the right to purchase this contract. So now, $2, you already made a profit of $7 here because the share price is now 40, and the agreement was to purchasing at $33 from the option seller, which they sold it to you at that price. Now you have to, of course, subscribe what you already paid in the beginning, which is the $2 here. So when you subscribe all of those, in the end, really your profit is now $5. That's your end up profit that you put in your pocket, and that was a good deal. Okay, so you really just made profit there. The seller on the other side, he loses money because at this point, after he received that credit from you of $2, he now had to pay you more in return because when he purchased the option, the shares back from the open market, it was more expensive than the strike price. So he lost. So his loss was essentially transferred to you. So that's essentially the easiest way to kind of explain options here. So let me clear this out. Come on. So I'm going to clear this out. So I hope everyone sort of understand the basics of options. So now we're going to essentially dive in much deeper on each basis of an options. So when you're looking at an option, for example, what are the most important things you want to look at? So if I'm looking at Uber, for example, if I go on trade option, first remember, option can only be traded between 9:30 to 4 p.m. Monday through Friday, and of course, no holidays. So whenever you click on trade options, the first thing you're going to see here, if you're looking at the Robinhood portion of it, what will be essentially your expiration. Oops, let's go back. You'll see a whole bunch of expiration that is available to you. So, come on. So you will see a bunch of expiration that's available to you for you to pay. So right now, let's say, for example, Uber share is about $33, okay? I realize, let's see, I think next week, uh, maybe in about a month, I think Uber can be maybe $40 because you looked at a few technical and you realize, okay, I'm looking at this candlestick here, pattern here. I'm looking at this 1 day pattern on this candlestick. It looks like a more of a bearish. Maybe not. So, but maybe you definitely saw something I personally don't see here that Uber will be $40 next week. Maybe you did see something and you realize, okay, Uber might be $40 by the end of the month. So now I already know my expiration date. So I'm going to bet for the expiration, July 31st. That's the end of the month. So now you're looking at a couple different price here. So everything that you see on the left side is going to be the premium. It's going to be the strike price. Everything on the right side will be the premium. So going back again, a few things I want you to know. When you're looking at option, there are a few things that you need to pay attention to, okay? And I'm going to write those things down here for you. First thing you want to pay attention to will be the expiration, because that's the first thing you want to choose. Second thing will be the strike price. Third will be I'll say the premium. And fourth will be somewhere, let's say, the implied volatility. And the last thing I personally looked at is the volume. Okay, so this really, it doesn't matter what kind of option you're purchasing, what strategy, whether you're buying a call option or a put options, all of these 1, 2, 3, 4, 5 things here should be very important to you. So you need to really look at each one of these 5 here before you go ahead and purchase your options. There's one last thing that you will need to look at, and I will go over there. I'll talk about it very shortly, but this is the main important ones. So once you get all of this here, for example, so now let's dive in each one of them deeper. I think we already talked about the expiration. Next, we're going to talk about the strike price. So let's talk about the strike price. So strike price. So what does strike price mean? The easiest way to explain strike price is essentially the price that you're essentially betting Tesla on. So I'm sorry, Uber. I'm not sure why I keep saying Tesla. That thing has just been in my mind all day long. So the strike price will essentially be the price that you're betting, the price of the price movement of Uber shares. So how do you even pick that price? Okay, so now that's where we'll talk about here. Let's go back to Uber. So when you're looking at options on this, all of this, like I mentioned here on the left side, they're all strike price, all these numbers, 25, 24, 30, etc. But they're all different in many ways. Now, they're not all the same. They're all different, not only because of the number or the price, but more of also in terms of the premium. A few ways to the options sellers option categorize the strike price is what we call in the money strike price. In the money strike price. And at the money strike price. And lastly, out of the money strike price. Okay, so you have in the money strike price. at the money strike price and out of the money strike price. So let's dive in deeper. What is in the money strike price? In the money strike price is just any price that you're looking at on the screen that is just below the current share price of Uber. So if I'm looking at Uber right now, $33.15, anything underneath here, anything underneath here, right here on the bottom, will be in the money. Reason why it's in the money, that means is because all the strike price are actually lower than the current share price of Uber. The one on the top here, so that's in the money. The one in the first one here, just right on the bottom of the share price, which is the one here with the $33 call, that is at the money. So the one right below the share price will be considered at the money share price. I mean, strike price. And then for out of the money, anything that you see right here on the top will be considered out of the money because they are much more higher than the actual current share price of Uber. So they are not in the money, they're higher, they're much more expensive. Not much more expensive, they're much more on the higher side than the current share of Uber. So that's how you categorize. So you have in the money, at the money, out of the money. So when you purchase an option, people always trying to ask, like, what is best? Should I purchase in the money, at the money, out of the money? I think it really, really varies. Really, in 9 out of 10, you really want to purchase your option in the money, which is the first one here. 9 out of 10, you want to purchase your option there. Also, at the money as well. Because in the money, there's a huge value for it. And likely, it's very unlikely that you might lose, or the price will fall to the point where that will make you lose. I mean, the price falling is not impossible. It can't happen. It will happen. Share price always goes up and down, etc. But you're just more safer if you are purchasing your share price in the money. If you purchase at the money as well, just as good as being in the money, really. I don't really see like a huge difference. I'm totally okay just saving a few bucks just by purchasing at the money, whatever I'm purchasing my option call in this particular case. But when it comes to out of the money, you can still purchase, obviously. I mean, a lot of people, you can still purchase your options also out of the money. But that means you are essentially very bullish on the actual price movement on the actual stock. So if I'm very bullish on Uber, for example, and I know that at some point before July 31st, that Uber will be $35 instead of $33. So currently $35 is out of the money. And that is why if you're looking at the premium for the $35 call, the premium is $1.07 versus if I'm looking at in the money call, so let's say I'm looking at the $31 strike price, the $31 strike price is $3.07. This is $35 strike price. So your option that are in the money, the premium will always be more expensive than the options contract that is out of the money. Because when it's in the money, there's more there's value into it. So you can literally quickly set it right back and you can still profit. Or you can exercise that option and you can still profit. But when it's out of the money, there's no extrinsic value. So you really won't be able to make anything there unless you're actually waiting for the actual strike price to be in the money sometime, hopefully as soon as possible before expiration. So that is really the difference. And of course, like I mentioned, you will see a huge price difference between in the money options and out of the money options. Let's clear this out. So I hope you kind of understand all the difference between in the money, out of the money, and also at the money strike price when picking your options. Now, we're going to dive a little bit deeper here. So we talked about the strike price. So now let's pick our strike price. So on the second time, I'm picking my strike price here. So I want to purchase, let's say in the money. I want to be in the money. I'm bullish about Uber. I think I'm thinking before July 31st, that Uber price will likely be, a little bit higher than what it currently is right now, because of all these deals like Postmate that they just signed that will drive them more revenue, etc. So they quickly adapting to this whole new COVID situation here. So I'm going to go ahead and say, okay, I want to purchase that $33 call options for July 31st, and I hope that the price move in the future. So when I click on that, the first thing I want you to know here, I feel like I mentioned that before, is that whenever you're purchasing options, you are essentially purchasing contract, and they vary from 1 to infinite. You can purchase 1 contract, or you can purchase 1,000 contract. I'm not sure how much money you have, but just keep in mind that each contract that you purchase, each contract actually will control one contract control 100 shares. So whenever you're purchasing a contract, the premium that you're purchasing, the premium will control 100 shares. So when we're looking at $33 call here, for example, the $1.90 here, if I wanted to purchase 1 contract for that strike price, I would essentially be spending 190. Was it 190? No, I would be spending $1,190 because I will need to control 100 shares, because this premium is per share, and 1 contract controls 100 share. So whenever I click on that, I want to purchase, it will show contract on the top. If I click 1, oops, I'm sorry, my math was wrong. It's not 1,000, it's 190. I always thought I was great at math. I've always been. I'm not sure what's happening tonight. So $190 will be what you will be paying. And of course, you can quickly see that right here. So where did that 190 came from? Because when you're looking at it right here, it shows, of course, 190 for the premium. But keep in mind that here for the Robinhood interface, it always shows you the middle. So let's dive deeper into how the option price comes into an effect here. So let's clear this board here again. Okay, so always want to look at this. This is where all the magic is happening in the background here. So you want to look at 2 things here. You want to look at the bid, and you want to look at the ask. So the bid is essentially buyers, just like yourself, who are essentially trying to buy that option at that strike price for that expiration. Right now, I can see there are 30 of them who are looking to purchase that. And on the ask side, those are sellers. I can see there's about 36 sellers who are looking to sell the strike options, this option contract to you, like a buyer. So as I'm looking at that, okay, so the buyer are asking for $1.83, and the sellers are asking for $1.96. So, and one other thing I do look at as well is the previous close. So it looks like the previous close, that's probably Thursday, it closed at 191. So you have a bit of growth there the day after. So it's now 196 from the sellers. So to pick my strike price, what I want to do essentially, if I want my order to fill, keeping in mind these numbers, they will change. So right now the market is closed, so that's why it's not really fluctuating. But once the market is open, if implied volatility is high, this number will constantly be changing every second or every minute. So right now it's constant because the market is closed, there's no movement. This stats that you're actually seeing was from Friday night. Friday afternoon before the market closed, where buyers were asking to buy for 183 cents and sellers were asking to sell it for 196 cents. So if this was Friday afternoon and I want my order to fill before the market closed, what I want to do is essentially quickly just on my limit price here, I will quickly put 196 because I want my order to fill right away. So I'm going to pay what the seller are asking. But if I'm in no rush and I feel like, okay, whatever, I can wait until my order is filled. I'm sure at some point, sellers may come down in prices. And I can go ahead and then bid it for the ask, just like other buyers are doing, and place my order for one contract, which is 183. Okay? Or I can decide, I think the buyers are being too cheap, and I think the sellers, they're being too stubborn. But let me do this. Let me meet both of this. Let me meet the seller in the middle. You know, I don't want to be like the other guys waiting for 183 cents from the seller. Let me meet the sellers in the middle. You know, he did all this work. He hold on to this contract for me to come and buy it today. I appreciate it. I'm gonna meet him in the middle. So that middle is what you're automatically looking at here on Robinhood, which is $1.90. Robinhood always do the math for you to tell you, okay, how about offer 190 to sellers? Maybe out of all those 36 sellers that you actually saw here, out of all of them, maybe one will meet you in the middle. So I'll go ahead and put it for 190 with you, and I will place my order. Currently, I don't have any fund here on my Robinhood. Typically, you don't use it much. So once you place that order will likely be filled. Typically, whenever I'm in the seller in the middle, typically it fills. Sometimes it doesn't, you know, until, you know, there's a nice sellers out there who decided to sell me this option contract. So that's really how you pick your limit price in terms of how much you want to spend for each one of those for these particular contract options. All right, so we talked about in the money, we talked about out of the money, at the money option, we talked about strike price. We also talked about exactly how we price our limit in terms of how we want to purchase the premium for those particular options that we're picking. Let's see, so looking back on my left here into my calendar to see what else I need to cover. Okay. Premium can have, okay, we talked about a premium. Now I think we need to talk about implied volatility. So we'll talk about implied volatility here. And this goes back again to the stats. So implied volatility is very important. So whenever you're actually purchasing, before you even purchase an option, you really want to know exactly what is the price movement that, not just you, because I mean, you have an idea. You think by July 31st, the share price of Tesla will likely be more than $33. This is you. I'm not sure. You probably did some research or probably saw in a dream. Who knows? But your opinion alone is not enough, obviously. You're not the only person in the market. So you want to try to get other people's opinion from the market who are also trading these options here, both buyers and sellers. So that's what implied volatility tells you. So implied volatility, the IV that you're looking at, is based on the movement on their stocks and what options buyers and sellers are expecting to happen for the stocks sometime in the future in terms of movement. So when I'm looking at this call option here, implied volatility right now is 57.80%. So if Uber is $33 right now, Uber is $33 right now. Oops. So, oops, let me this thing never works just like I want. Okay. So Uber is 33, price movement. So essentially, options buyers and sellers, they're all expecting a possible movement somewhere in the future. It could be a month from here, it could be a year from here, it could even be sometime 2 years from here. So they're expecting a movement on the stock price to be range about 57. Let's just say 57%. I'm not going to go to the minus here. So they're expecting a 57% movement, both on the upper side or even on the lower side. So quickly here, 57% of $33. I will have to use my calculator here. 1881. So on the upper side, 5181, and on the lower side, 1419. So what this is essentially telling you is that Uber currently will likely, based on all the movement from option traders, etc., and option buyers, they're expecting a movement between $51 and $14. So there's a 70% chance, I would say probably 65 to 70% chance that Uber will move somewhere around in the future, will move between $14 and $51. So obviously, if I'm looking at this implied volatility here, I don't really want to put a strike price of $70. That's like, it's almost as if I know something, those option buyers and sellers, or the statistic, the mathematic that was done to get this number of 57% is obviously crazy. At least that's what I would think if I decide to choose a strike price of $60 or $70. So I always want to be between these numbers here whenever I'm picking my strike price. I will always want to be somewhere maybe in the 40s or 50. There's 70% chance that Uber share price will move between this range here. And I'm not saying that it won't move past this range. Yes, it can. Uber can lose its value. Something can happen. I don't know, something crazy could happen to the point where Uber falls down to $5. It's possible. Or something crazy can happen where Uber can be trading $100. It is possible. So the implied volatility can still move way beyond the expected movement. The options or option traders and people really were expecting the movement of the price to move based on the pricing, the way the options were priced, etc. So that's how implied volatility is really important. So whenever I'm picking my strike price, I always want to be between these 51 and 81. If it goes beyond the 51 and I'm on the call option, hallelujah, I will make so much money. And if it fall down, oh, God help me, I will lose so much. Yeah, that's really, there's a lot more mathematical stat that actually goes beyond how this idea is calculated, but that's the easiest way I can explain it. One thing I also use as well, you could use it as well. If I'm going to market here. So market chameleon, actually, sorry if I say it sort of in French, right? I'm not really sure the English version of it. These tools can actually help you see historical implied volatility of what was expected. So let's say a month ago, what was the implied volatility that options trader were expecting? And you can also see what was the actual move. Did the stock move like they were expected? Was it within that range that I showed you, or was it outside the range? So if I'm looking down here, so if I decide to go to Uber, right here on the left side, volatility, implied volatility. Am I logged in? Yes, I'm logged in. So implied volatility. And I can quickly look here. Oops, where is it? Implied move. If you're looking at the bottom here, like for example, on July 9, this was Thursday. Actually, let's just look at July 10, which was last Friday from the day I'm making this video. The implied volatility of the implied volatility move for our Uber was about 3.1%. So based on option buyers and sellers and the price, there was 5 turn to those premiums, etc. They were all implied a move of 3.1% on Uber stock. But unfortunately, it did not happen that way. But it still moved within that range because it's between 0 to 3.1%. So it did not move at all. It was zero. It was literally flat. So which is why it's showing within range. Yes, it is within range. So if I'm looking, for example, at Tesla here, and I'm looking at volatility move, I can see that last Friday, from the day I'm making this video, on July 10, option buyers and sellers were expecting a move of 3.5%. So there was a range of 3.5%. I think, I'm not sure what, I will have to write down to see what the mathematical was. 3.5% was the expected move of implied volatility, but Tesla actually defied all odds and literally went up 10.8%, close to 11%. So is it within range? No. That's because it literally should be within that range. It wasn't between this interval that I showed you here. It wasn't between this range here. It literally went past. It went past the range on the upper side, which is amazing for people who actually owns. For people who owns these options, especially the calls. So that's how good this tool is. And of course, if I'm looking right here, implied volatility, I can also look at the current implied volatility within 30 days, 20 days, historical implied volatility, historical move. So right now I can see that the implied volatility, the current implied volatility of Tesla is higher than it used to be in the past. So from what I'm looking here, I can automatically tell that option trader, they're still expecting a lot more move on this stock. So they're expecting Tesla to continue to run, literally. And I love this. I mean, most people want to trade option where the implied volatility is high, because if option buyers and sellers are expecting a huge move, it continuously move on the stock price in a positive way, then it's really a good time to jump into the trade as well, so you can ride it, so you can ride along with everyone else. So that's implied volatility here. I hope I explained it much better way. This graph also helps as well. I can see here implied volatility was really high on March 18. On March 18 was literally, I think, the day where everything was getting shut down because of the COVID-19. So implied volatility was really high. I think people were likely selling the shares of Tesla, their position. They were likely closing their position or reducing it because everything was falling. And there were also buyers as well who were buying from the fall of the share price, etc. So implied volatility was really high there. So it slowed down after. And now it's been picking up back again slowly. I can see it was really high here on July 10 after, of course, the movement on the stock price of Tesla, which was almost 10% just in one day, which is insane. That's it on there for implied volatility. Next, what we're going to talk about would be moving higher. Okay, cool. All right, so the option stats here. Let's look at one other thing here. So when we were looking at this pricing between buyers and sellers, there's other a few things, of course, that you probably noticed there. Volume is very important. You always want to look at the volume, because obviously you don't want to purchase an option. It won't be able to sell it. Even if you move, you need to make sure there's pretty good volume so that you can move in and out of the trade. 82 for me it's low, but I would still take it. I mean, Uber is a pretty popular company. It's been traded. So you probably get more volume as it goes, probably less next week. There's probably more volume on there. So I can still trade this because you really want to be in and out of the trade whenever you're ready to sell. So you need to make sure that they are buyers. They're trying to buy from you. On the bottom here will be the Greeks. The Greeks, I personally don't pay much attention to it, really. Delta with 54 cents simply tells you for each dollar that this share price, which is Uber, will make. If Uber right now, which is $33, if Uber is now trading at $34, if Uber is now trading at $34, Delta will move to the premium that you paid will move by 54 cents, which is pretty good money. And Tether will be essentially how much you pay, how much you're paying every day to be in a game. So being in a game, you have to pay. So being in a game, you essentially will be paying for every single share that you have. You'll be paying about 4 cents every single day. So you are essentially losing 4 cents every day per share. So if you have one contract, so you'll be essentially losing 4 cents per 100 share. So which will be, I believe, $14. Yes, so you'll be losing approximately $14 every single day until these options expire, which will be on July 31st. Cool. The rest are really, it's not really the gamma. I don't know the math behind it, but the math behind it is how the delta is possible. You really don't have to be concerned on that. Vega and RHO, you really don't have to be concerned about. I never bothered to learn because it's really negligent. You don't need to know all those. And that's really it here on this side as far as the stats. But one good tool that I personally really care to use, obviously, whenever you purchase an option, you don't want to lose. So technically, you really shouldn't care about how much you'll be losing every single day. Keep it in mind, what you will lose on your options will be the premium that you pay. That is the maximum that you can lose. You can never lose more than what you pay for that option premium. But what is important to you is how much can you gain, right? So let's find out. Options. So this is a good tool, options calculator. This helps you know beforehand how much you can potentially make. If you don't want to do the math with the delta, etc., and you just want to just type in a few numbers, a few letters, and it will tell you, hey, you'll be rich by this amount of time. So let's see. So we're talking about Uber. What you need to do, first you will need to pull your strategy. If you are going long call, meaning you are bullish on a position, long put, bearish on Uber, or cover call, or if you're selling spread, etc. That's a discussion for another day, which I will probably make another video to just talk about that. So on a long call, so this is what you likely want to be doing most of the time if you're new into trade. So Uber here, you type the symbol of Uber, which is also Uber, get price. It will automatically tell you the current price of Uber, which is $33.17. And right here on the screen, I can select the option. So what you see here will be the same thing you were looking at on Robinhood. You will also choose the expiration date, July 31st. I believe we're looking at a strike price of $33 right here. And we decided that we wanted to meet buyers and sellers. We want to meet sellers in the middle. So we decided that we're picking the 190 premium for each contract, for each shares and contract that we are purchasing. So if I'm purchasing one contract, I'll be paying $190, right? Okay, fantastic. I'm purchasing one contract. Graph range. So Uber is 33. I can maybe say it may fall to 29. Who knows? Okay, now the second part. Okay, how far can it go? By July 31st. Maybe when I had a dream last night, I saw that Uber was trading at $40. Who knows? We've been $45. Calculate. So everything on the bottom here will be, of course, below the strike price that you pick. So, and they're all red. I mean, because obviously if Uber falls down from your strike price, Uber is trading lower than the strike price that you picked, you will be losing money. And the more it falls, the more money you lose. And of course, the maximum that you could lose will be the price that you pay, $190. That is the maximum. Even if Uber was trading at $0, the maximum loss would still be $190 of loss at expiration. Right here, typically before expiration, it may be worth 1 cent. Then our expiration is worthless, so you lost everything. And then right here on the top will be on the positive side. So that means your bullish position really paid out. Uber, something fantastic happened. The stock share started to move. People were buying. Everyone is happy. The stock kept moving, blah, blah, blah. And boom, we have $45 by July 30th. Okay, so this right here is the day. So the day before expiration, or even just right here. Even let's say the day before expiration, because I think someone asked me if you could sell, if you just get out of a position the day, or even the day of expiration. You could see right here, yes, the day of expiration, July 31st. Yes, if Uber is there on that last day, I will be making a profit of 532%. Okay, that's a huge profit, literally. I went from $190 to about $1,000. Good money. Day of expiration, that's when I want to sell it. I'll go ahead and sell it back to someone else, likely at the ask, get out the position, and pocket my profit. And keep in mind, you can sell it anytime. If you feel like if Uber arrived to $45 somewhere on July 19, and you feel like, okay, I mean, I don't need to wait till July 31st. I just want to get my money out right here. It's already enough for me. I don't want to be greedy, and I can just cash out quickly right here on July 30th out of that position. And this is pretty good tools to use. I use it quite often to play things. And let's talk about one thing I didn't kind of took an example here. So if you're looking at it here, the maximum you can see here, the maximum profit based on the input that we have in there is 532%. That is the maximum profit if Uber is at $45 before expiration. So 532. So let's play another example here, scenario here, where I'm picking a strike option, which is out of the money, because remember we paid the $33, which is in the money. So let's pick one which is out of the money. So let's pick a strike price of $36. Okay. Actually, let's pick $35. So the strike price of $35 obviously is cheaper because it's out of the money. It doesn't have any intrinsic value. So therefore, it's much more cheaper. It's only 91 cents. So that is literally less than half what I paid before for the other strike price. So $91. So let's say I picked the options and the other person picked the other options. So when we calculate, if Uber arrives at $45, I mean, same thing here. If Uber goes lower, you will lose. The maximum you could lose is the $91 you pay. But if Uber is at $45, you can see this is huge. So the actual percentage of return is actually much higher. You are literally at 945%, literally close to 1,000% in terms of return versus 532% return on the other side. So if you are out of the money, obviously you are paying cheaper for the stock for the share price. But because it's so much of a bigger risk, there's also a bigger reward. Just like they said, bigger risk, bigger reward. If I'm out of the money and my call option, my bullish position just turned out to be right, I will make huge profit, better than people who purchased in the money because they were trying to be safe. And I decided to take a lot more risk than they did, therefore more money for me. Hallelujah. Okay, so that is that right there. Whenever I'm I remember when I first started trading option, I used to play with these numbers. Instead of I used to look at 1,000%. In some cases, literally, you will see like 6,000%, 10,000%. I'm like, how you make fucking 10,000%? You mean to tell me I can turn $10 into more, like freaking $100,000? Really? Jesus Christ! In less than a month? How is that possible? But it is. It's just how things works. It's the world we're living in. Nothing makes sense. All right. So we talked about option profit calculator. We talked about how you look at implied volatility moved. We talked about the stats here as well. What else? Let's see. Okay. All right. So going back here to my list of things here. Volume, open interest, we talked about that. We talked about the Greeks, gamma, convergence, we don't really care about that. Put options, quickly talk about put option here, and then I will answer a few questions, and that'll be over. So in terms of put options, so going back again to Uber. So if I didn't want to buy a car, and I decided that I think Uber's share price will actually go down. So I'm not hoping it will go up. I'm thinking it will go down. And as it's going down, I also want to profit. Literally, it's crazy when you can even imagine that you will actually make money if the price of the share goes down. It's insane, but yes, it is possible. That comes with the put options. So you can purchase the put options if you feel as though Uber may come down from 33, maybe it will come down even lower. And you can see now that literally what we saw on the call option is now different than what we're seeing on the put option, because in the money and out of the money is now much more different. So anything which is lower than the current price of Uber is actually out of the money. So what is not is below the Uber share price is cheaper, but it is out of the money. Right here on the top is more expensive. I mean, it's more higher than the share price, but it is in the money. The reason why is because now we are essentially betting the price to fall down. So therefore, down is in the money, up is out of the money. That's just literally the easiest way I could possibly put it. And you can also notice that here in terms of the premium, you can see right here, the in the money, which is the top here, are more expensive than the premium that I'm looking at on the bottom here. So what is essentially happening here with option buyers? So they're buying this because they're hoping they will buy a $36 put, for example, which is $3.63 per share, which will probably cost about $363 for one contract. So they will purchase that, and they will essentially hope that Uber shares goes much more down. I mean, Uber is already down. I mean, if you're looking at it from 36, Uber is 33. So if Uber continue to go even lower, if Uber is at $29, for example, this strike price will be more in the money, will be much more higher, which would then drive the volume. So just put a perspective here, back to what we were looking at earlier in terms of the option calculator. So if I'm looking at the bearish position here, and I'm picking Uber again for the same example. Get price $33. I'm buying a put option, so you will now see that the put is actually on the right side. The call were on the left side, the put option. So I'm going to buy one that is in the money. In the money will now be in the bottom versus being on the top. So anything in the bottom will be in the money. So I'm picking the strike price. I think we picked $33. We picked 33. We can still pick 33 here for this example here. 115. Now, so this call option is costing us $115 for this call option. So in terms of price range, we estimated between 25. I mean, same thing. Let's do 29 and 45. Okay, calculate. So you now see that if Uber price goes up to $45, I will actually be losing money. So if Uber price rise up, I will lose every single thing that I pay for this option premium. But if Uber actually falls down, I will actually be making profit. The more it goes down, so if I put here 20, for example, the more Uber will go down before my expiration, the more profit I will stand to make. See, if Uber falls down by some miracle all the way to $20, I will be making a percentage return of almost 1,000%. So you can profit. So I think that's the beauty about option. Depending on your bet, you can literally profit whether your option goes up or the option goes down. You can even profit if your option remain flat, depending on the strategy, of course, that you're using to purchase that particular options between you and the sellers. So these are all the beauties about the options, I think. And puts literally just the opposite of the call, where the more expensive, the more the strike price is higher than the current price of the share, the more in the money it is, and the less the strike price is way below the share price, the more out of the money it is. So we talked about option call, we talked about puts, we talked about the gigs, we talked about the stats, we talked about the premium, we talked about how you see your profit, what you can possibly make, time decay. So that's one thing I did forget to sort of touch on. Time decay really is literally just the time. Remember when you were purchasing those options, you purchase, you choose an expiration. So, like I mentioned, when we were looking at Theta before, I mentioned how much you will actually be losing. So this is all factored by time decay. Every single day, how much you actually lose for that particular options. So as you're losing, of course, if the price is moving, you're also making return as well. So you're losing somewhere, you're making more somewhere. But if the price doesn't move, then you are just losing. That's it. If, for example, if we're talking about a call options here, and that is it on all of that. I think really, if you've been watching it, you should feel pretty comfortable in purchasing options from here on. Really, and one thing I did forget to mention will be how to close your position, because if you're looking at the Tesla, Tesla, man. If you're looking at the this step right here, I'm sure you notice it says something sell over here. So this is not how you sell your option to get out of your position. This is something totally different. This is you being a seller, which is literally totally different. Which I will talk about this in another video. But you really don't want to play with this at all. You don't even want to touch it until you know exactly what you're doing. But if you wanted to close your position and sell your position, you essentially, so I think I don't really use Robinhood, but I believe I have some position open here on QQQ. So I think I have some position here for the strike price. So because I already have a current position for this strike price, if I click trade option, it will automatically show me the sell button right there. If I didn't have any position, it would not show me the sell right in the middle there. Because I have some position, I can quickly click on sell. It will, on the top, I will see how much contract I currently have, which is, I think I have 94 contract there. If I wanted to sell all 94 right now, currently, I will stand to about $1.94. That is if I'm meaning the buyers. In this case, because I'm the one selling, I will want to meet the buyers in the middle. Okay. If I don't want to meet them in the middle, I can just be stubborn and say, hey, I mean, you guys have to pay me $1.97. I'm just going to be just like every other seller out there. I say, okay, I'm going to 197. It's either that or nothing. We're not doing business unless you pay me 197. Review, swipe, submit, order receive. That's it. And I'm just going to wait for a buyer to purchase it at the bid, which is the price that I'm asking for here. And once they purchase it, my order will be filled, my money will be in the account, and I can choose to do whatever it is I want to do with it. Right now, it's showing order queued. That's because you can only trade option, like I mentioned, between 9:30 and 4 p.m. Monday through Friday. Right now it is Sunday as I'm making this video, so the order won't be in the market until the next trading day, and at that point, it will either fill or not fill. So right now I'm just going to cancel it because I don't want to sell it just yet. These options have a few months left, a few months to mature. So I'm going to wait till maturity to see what the benefit I can get from my QQQ before I sell it. Okay, so that is it on that. I believe, yes, I think that is really it. I don't think, I believe I cover everything here. If you have any question at all, like I mentioned, if you're watching this on YouTube or any of the platform that may post this on later, just feel free to just shoot me a question. I'm happy to answer some of those questions. But before I end this, there's a few questions that was indeed sent to me shortly before. So I'm going to go over those questions from people who registered to my webinar. So there's about 75 questions. Okay, so essentially I asked folks to tell me exactly if they have any question or comments. So some of them would maybe just comment, for example. I'm interested in learning when is the best time to put in call or put. Really, call or put, it really just depends on how you feel. If you feel like the option price, the stock price might go up, go with the call. If you feel like it might go down, go with the put. That's really all how you identify which way you're going. Someone say as well as the Greeks. We already talked about that. I also show how to purchase the options as well. How to properly place the call and put option, and what call and what time before expiration. I think I've already covered that as well. How do you identify a good option based on the technicals? For example, what about IV volume? I think I spoke about IV. It's like Implied Volatility. I spoke about the volume in the Greeks as well. Stock analyst says, I want to learn the right time to make an option play to call. I already answered that question. Has the option so much more valuable than stocks? Sometimes the premium can be much more expensive than the actual stock price. And that's only because of expected implied volatility of the stocks. So the stock may be $2 right now, and if option buyers and seller feels like it will be worth a lot much more higher in the future, that's how they essentially price that premium. So that premium will be quite expensive because there's a high demand for it. Everyone wants it because they know, oh my God, this shot is going to shoot at some point. They're very sure for it, and they want to be able to take advantage of that movement on the stock. So implied volatility is high, the stock will be high as well. The premium will be high as well, depending whether you are in the money or out of the money. Interesting learning about options and how to buy options. On Ameritrade, interesting. So do I have Ameritrade here? So I'm going to quickly show how to purchase options on Ameritrade. So I'm gonna open my Ameritrade account here. I don't really use it a lot either, but I have an account and I can quickly show you folks how to trade with Ameritrade. So right here we're on Ameritrade. Okay. Oops. Clear. Okay, so we are trade. This is Ameritrade. So let's say I wanted to trade. What am I trading? So we were talking about Uber. So Uber. So it's the symbol. So it will automatically show me stocks because they're always expecting you to be playing with stock for some reason. So I'm now going to choose options on the right side. So right here on the top, I will see the strike price, $33, the bid and the ask. And now I'm going to view option chain, which is the same thing that we were viewing on Robinhood earlier. So it's very strange way, like I mentioned earlier, the first thing you want to pick is your expiration. Same thing here as well. We are Ameritrade, you will pick your expiration. So we're looking at July 31st. So I want to see everything on July 31st. The others doesn't concern me. So now on the left side, I'm looking at the calls. On the right side, I'm looking at the puts. On the left side, and in the middle, I'm looking at the strike price that I want to pick. When I'm looking on the left side, the one on the right of the left is the ask. Is the ask from the sellers, and the one on the left is going to be the bid from the buyers. And of course, you can meet them in the middle. I'm not sure why Ameritrade does not show you the middle point, just like Robinhood does, but you can make your own middle yourself. So let's do this. So calls, we're looking at 33 cents, $33 strike price, $33 strike price. The sellers are asking for $1.96. The buyers are asking for $1.83. Remember, we found out that from Robinhood, the middle was $1.90. So I will still pick this right here, the 196 here. Once I pick the 196, I can actually make a change. I can change it to 190. See that? So I've modified that to about 190. Now I'm entering how many contracts I want. So one contract at 190 cents, and expiration the day. Or if you wanted to expire until to cancel, then you can put it there. Typically, I just leave it for the day because I wanted to fill that particular day. If it doesn't fill that particular day, I'll try again the next day because I want to have an eye on it. Remember, the price always moves constantly. So I wanted to be able to see the movement on the price before my order even filled, if it doesn't fill right away. So yeah, and you can see here, the total will be 190, just like it shows on Robinhood. I can review my order and I can place my order. Robinhood does ask for another password. I'm not sure why they do that. And you can see here, Uber, July 31st, 2020, $33. We're purchasing a call option. We are buying to open one contract at a limit price of $1.90. So buying to open is actually pretty. You're going to see this a lot when you're using a broker like Ameritrade or Thinkorswim or Webull, etc. So you're going to hear a lot more of those terms. So when you are selling, you are essentially buying to close. You are selling to close your position, which is STC. buying to open, BTO. You're going to see that quite a lot as you're trading. And yeah, that is really how you purchase trade options on TD Ameritrade, and I can place my order and it will be filled. If it doesn't get filled, that may probably because we're meeting sellers in the middle. But if I want to fill right away, I'll just pay what the seller are asking. That is it on that question. Gonna answer 2 more questions, so we should be done here within 10 minutes. What will happen at the end of the call option if the option is in exercise? So you really don't want to exercise your options contract. It's very rare chances where you may have to exercise it, but it's 90 out of 100 or 99 out of 100, you never want to exercise your options. So I'll try to skip that question. Is it always deemed worthless and you lose the invested money? Are you able to sell the day it expires? Yes, I did mention you can sell the day it expires, but you can only sell the day it expires if there is value to it. So that means if your call option is still, if your strike price is in the money, then you can sell it the day it expires for profit. If your strike price is out of the money, then you can still attempt to sell the day it expires, but there won't be any buyer because no buyer wants to buy an option contract that has no value to it. So because there was no buyer, therefore it will just expire worthless because buyer don't want it. It will only be valuable to a potential buyer. Yeah, that's correct. If it's above the strike price. I wouldn't say above the strike price. It really just depends on what you're looking at. Because if you're looking at put, if you're looking at call, you want it to be below the strike price, to be in the money. If you're looking at put, then you want it to be above the strike price to be in the money. How would you maximize profit on an option? Would you be purchasing the 100 shares or selling the contract to someone else? Yes, so that comes to what I mentioned earlier. You never want to exercise it. So by exercising it, you essentially will be purchasing the 100 shares for the strike price you mentioned and then sell it to the open market. If you do it that way, you'll just be taking the intrinsic value, which is good, but it's not great because if you just sell the option back right away to the contract to somebody else before it expires, you actually have more profit there than exercising the options. So the extrinsic value when the option is in the money before expiration is always higher than the intrinsic value on the money when your strike price is in the money. Explain how do I find companies, when to get out. Get out when you find your profit, or get out when you feel like you're losing and want to reduce your loss. Read them out, details, please. I think I spoke about that. How do you secure options? You never want. I think you meant exercise. You never want to do that. For trading platform do you use or recommend? I really use all of them. Really, I have plenty of Charles Schwab, TD Ameritrade. I don't really use that, but I have it. But really, I use anything out there that will help me. Someone's asking, trading options more risky in general than just, I guess, trading stocks. Yes. Options are very risky. So in terms of, so if you're essentially trading, let's say stock, for example, remember you can actually purchase the share of that option and then hoping that sometime in the future, it could be 5-10 years from now that it goes up. So you're not really playing with time decay here. So you can wait even a decade or 20 years after. So your shares will always be there. With option is different because you now have an expiration. So if the price does not move as you expected before expiration, your options will expire worthless. So options are more riskier in that way. I think I also covered how to trade on Ameritrade already. So I think this is it. I hope you now feel more comfortable now about how to trade options, and you are ready to get started here to buy your own calls and buy your own puts. Just be very careful. Options, like I mentioned throughout the video, are very, very risky, which is why the reward is also so much larger. So on my next video, what I'm going to cover will be how to sell options. If you want to be on the short side of the aspect, be on the other side of the table, start collecting this premium for yourself. Then I'll cover that on the next video that I'll make. Please make sure you subscribe to my channel. And if you like this video, please click the like button. That will help the algorithms. Thank you very much. Cheers. Bye.